Nutmeg are the UK's largest and fastest growing digital wealth management services. We reviewed the robo-investment platform back in February 2019 and I was so impressed with them that I continue to invest a small part of my wealth into their platform on a monthly basis.
Other than the great investment returns, one of the things that we loved about Nutmeg was their transparency and the huge amount of information that they make available on their website. Some investors just want to give their money to the pros so they don't have to worry about it themselves. For others though, they want a deep understanding of what is happening with their money.
We know your time is precious, so we've gone through some of the Nutmeg resources on their website, and in this video, we're going to look at how Nutmeg choose ETFs to invest in and check out my actual Nutmeg investment portfolio. Whether you invest in Nutmeg or not, this is a great resource to learn exactly what to look for when selecting ETFs. Let's check it out.
Welcome to MoneyUnshackled.com, the investment channel that sets you and your finances free. This is Andy, I'm Ben, and if you like what we say, hit the like button and click subscribe.
Also, we have hundreds of pounds of welcome bonuses that you can snap up if you sign up to one of the investment platforms listed on the offers page of MoneyUnshackled.com. There you'll find our Nutmeg link. Sign up to Nutmeg using our link and you'll be given the first 6 months without fees. The link is in the description below. Let's get into the video. Who are Nutmeg? For more info, check out our full Nutmeg review, but briefly, Nutmeg is a robo-advisor that will ask its customers a few questions and then invest the customer's money into one of its many portfolios that it considers most suitable.
These are put together using exchange-traded funds, or ETFs as they're more commonly known. We at Money Unshackled love these as they're a great instrument for achieving huge diversification at rock-bottom prices.
So, how do Nutmeg select their ETFs? Number 1, the components of the index. They look under the bonnet or hood for our American viewers to find out whether they would actually invest in the stocks that make up the index. Many indices are weighted by market capitalisation, meaning that many of the larger companies make up more of the index. We often use the FTSE 100 as an example, with Shell making up about 11% of the index all on its own. By looking at the underlying components, they can assess whether the index is suitable.
Number 2. Method of replication and tracking error. Not all ETFs own every single stock within an index. This can sometimes be difficult and costly. Rather, they will choose to only invest in a sample of stocks within that index. This is one reason why ETF performances can often deviate from the index, in what is known as tracking error. We at Money Unshackled prefer ETFs that use full replication, but this isn't always possible. Nutmeg will then assess the tracking error and will then choose funds which are as closely aligned as possible.
Number 3, costs. Investors these days are very conscious about costs, and no surprise Nutmeg invest in ETFs that keep costs to a minimum as long as they meet the other requirements.
Number 4, size and trading volume. As with stocks, many small ETFs don't trade in high enough volumes to be considered liquid enough, so these will be avoided, or at the very least make up a small portion of any portfolio. They also seek ETFs with low bid-offer spreads. This is the gap between the buy price and the sell price, and this gap can get quite large on ETFs that are traded infrequently.
Number 5, the type of ETF. Some of you might be surprised to learn that not all ETFs directly own the underlying stock or investment. Those that do are known as physical ETFs and are our preferred type. In fact, we won't ever invest in any other ETF type, and to our relief, neither does Nutmeg. The other main type is a synthetic or swap-based ETF. These involve legal agreements between two parties to produce the return. This will expose you to counterparty risk, and in Nutmeg's and our own opinion, it isn't worth the risk.
Other considerations. Many ETFs will leave the investor exposed to currency risk, and in some cases, Nutmeg will invest in a hedged version to reduce this risk. Also, most of the major ETFs are very straightforward index tracking funds. However, there are some more exotic, actively managed or enhanced ETFs, which Nutmeg may seek to take advantage of. However, Nutmeg have said that these won't make up a large proportion of any portfolio.
What ETFs do they invest in? In Nutmeg's own words, they invest in a universe of over 1,800 ETFs and favour physically backed ETFs with high liquidity and good tracking performance. I was assessed to have a high tolerance for risk and was placed into this investment portfolio.
We can't go through all of them, but as you can see, over 35% of the portfolio is in the iShares Core S&P 500 ETF. Note that this is the hedged version, which attempts to minimise foreign currency risk. We totally agree with this position. All investors need to have a large exposure to the US as it is the world's major market, but as UK investors, we also want some protection from currency swings. This achieves this and also comes with a total expense ratio of just 0.1%.
Next in the list is the Vanguard FTSE 100 ETF at around 10%. Again, we totally agree with having a large investment in the UK's 100 largest listed companies. This is extremely cheap at just 0.09%. We have always loved Vanguard, but have to wonder why Nutmeg didn't opt for the ever so slightly cheaper iShares equivalent. Both are dirt cheap, so it doesn't really matter either way, but perhaps they were trying to reduce exposure to just one investment provider.
Next on the list, with 9.5%, is another iShares S&P 500 ETF, but this time it's not hedged. Again, this is the US's major index, and the lack of currency hedging is perfectly fine in our view because we both have a high tolerance for risk and reward.
In fourth spot is the iShares S&P Small Cap 600 ETF at 6.4% of the portfolio. This is riskier as it offers exposure to 600 small US companies. We both love this because smaller companies tend to outperform larger companies. You may have heard of the saying, elephants don't gallop.
The portfolio contains many more ETFs, but the allocation percentage gets far smaller as the geographical markets become less significant to UK investors. For time purposes, we can't delve any further, but Nutmeg provide a full explanation of why they invest in each ETF on their website. If you would like us to dedicate a video to exploring their chosen ETFs further, then please let us know. And don't forget, sign up to the Nutmeg platform through a moneyunshackled.com offers page and you get 6 months without fees.
Question of the day. What do you think of the Nutmeg's portfolio that I'm invested in? What do you think they're doing right and what are they doing wrong? Let us know in the comment section. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. If you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.